being early does not guarantee leadership. And it's really important that Europe thinks about that and thinks about how do we remain competitive. That needs an explicit commitment to responsible growth and innovation. Definitely a single market edge, but it comes with risks, either disparity in treatment or slowness to kind of stay agile.
The most progressive institutions here are probably at the stage of unifying the evaluation of risk as it relates to transactions in both fiat and digital assets. There is a unified plane in which they do that. But that is on the most mature end. 90% of organizations are not yet there. If you have digital assets as part of your treasury management policy strategy, most organizations are running these treasury strategies independently.
If we think at Elliptic just about deploying our own AI-enabled crime detection, you've got three very different attitudes to our roadmap. Some who are like, go faster, go faster, go faster, we want it now. And then others who are like, oh, what does this mean?
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome, everyone, to the European VC podcast. Today, we're exploring the outlook for digital assets at the point where crypto-native innovation and traditional finance systems are increasingly forced to meet. Simone Maini is the CEO of Elliptic, a leading blockchain analytics and crypto risk management firm, working with financial institutions, crypto companies, governments, and regulators globally. Jay Wilson is a partner at AlbionVC, backing early-stage technology companies that often sit just ahead of regulatory and market inflection points. Today, we're going to talk all about where real opportunity is emerging, what remains structurally hard, and how founders, investors, and incumbents navigate the next phase of digital assets. Simone, I want to start with you. I want to ask you, because Elliptic sits right at this intersection point of digital assets and the traditional financial system. I'd love to understand what your company actually do on the day-to-day and who depends on it.
Yeah, fantastic. So at Elliptic, what we are doing is really providing what we call the intelligence layer for on-chain finance. So what does that mean? Well, we think of ourselves, we operate as a data company that specializes in crypto, in digital assets, whatever term you want to put on it, to really help understand what's going on chain. So that means we're helping institutions answer really practical questions like, who am I dealing with? Where did these funds come from? What risk is embedded in this wallet or this transaction? And we do all of that on a real-time basis because people need to know the answers to those questions right now, not next week, next month.
Simone, that makes perfect sense. Jay, I want to ask you the flip side of that question, which is, of course, how is Elliptic a venture case?
The best venture cases, the best venture thesis are really simple at heart. You have to really believe two things. First thing is that digital assets are going to play some substantial role in our world going forward, and we can debate a time frame. It may be 5 years, it may be 10 years, but let's say we believe that. And today, Simone will tell you much more than I will, but today that isn't not a contentious thesis. I think we generally believe that. And then number two, you've got to believe that, this is in the category of obviously needed technologies, right, to support that ecosystem. And again, we made the investment in 2019, and I think probably you would have debated that in 2019. You were at a phase of the market that said most companies just want to tick the box in terms of compliance, but actually will organizations move from that to really wanting to fight crime and have institutional grade infrastructure? And if you believe those two things, then you believe Elliptic has to have a venture return case. And as I said, today we have much more conviction over those two things. But 5 years ago, it was much less obvious.
I'd love to understand from your side, Simone, then your geographic expansion, because you've raised many millions by now. I think your last raise was a 23 million Series A, if I'm not mistaken. I'd love to understand exactly where you're moving now, why you're establishing regional headquarters in UAE, and what that tells us all about where the digital asset activity is concentrating.
Our last raise was actually a Series C, and we're in the process of closing out a D round right now. Yeah, in terms of how that maps to geographic growth, for us, we've always being a global company, from having customers all over the world, teams all over the world. We've never really thought about ourselves as being sort of centered around one specific place, because crypto by definition is borderless, and we have very much had to build a business that is kind of natively thinks about itself as borderless as well, as much as can be the case. In the early days, our kind of center of gravity was more in the US, because FinCEN, the US financial regulator, was the first to lay down rules and regulations around crypto. And so that's where you would naturally see the most business. Over time, that has shifted. We have a really strong, well-performing business in Asia Pacific, for example. We're based there out of Singapore. The Monetary Authority of Singapore has been pretty progressive on crypto. So again, both crypto businesses feel comfortable establishing themselves there, fintechs, and then more recently banks are getting quite active into the digital asset space in Singapore. The UAE was our most recent kind of official launch, and that was about 18 months ago now, and that really reflects, again, what's happening from a regulatory perspective. Because if there isn't regulatory clarity somewhere, then it's going to be quite challenging to open a market. So the UAE, a bit like Singapore, a bit like the EU, has got really clear regulations, has been very progressive about how do we establish ourselves as a strong digital asset financial center. In fact, the UAE has the only digital asset specific regulator in the world. But it's really a kind of global dynamic now. The EU has got regulation called MiCA. The US, we've seen the Genius Act pass. We're hoping to see the Clarity Act go through. And so you're seeing that kind of rising tide of regulation around the world, and it kind of goes back to Elliptic being nimble and flexible about, which markets we're going to operate in.
I imagine that there's no one better to ask almost than you about, as you're describing, we're seeing movements in all these markets, and we've also seen in the past movements in the other direction. As an example, as you described before, we got the Genius Act in the US and now the Clarity Act. We had a time where crypto was deemed dead in the US. Can you talk a bit about how people should think about where the market is today and how volatile it is on the regulatory level? Because at least from my side looking in, and I'm in no way a crypto person, it feels like this is going to happen. It's absolutely needed. Everyone, as we saw, von der Leyen even announcing that we need this in Europe to get on the right rails and free from the visa system and so on. So I'd love to understand from you, how should we think about the geopolitical movements when it comes to crypto?
Yeah, it's a really interesting question. And having been in Elliptic and in this industry for a decade now myself, and Elliptic's been here for 13 years, I have the benefit of sort of taking a step back and looking at how this has evolved over a long period of time. And I can understand for folks that are maybe newer to it or come to it in kind of specific moments that it does feel rather volatile and uncertain, and that there are different players kind of facing off in different ways, whether that's geographic players or whether it's industry players, sort of crypto versus banks, for example. We're seeing a bit of that in the US. The benefit of obviously having been in it for a decade is we have been very accustomed to all of these ups and downs. And in more recent times, certainly those ups and downs feel much less volatile than they did, 5, certainly 10 years ago. And so as Jay said earlier, when Albion invested in 2019, it certainly was the case that we had to make a really strong case for, no, like this thing is here to stay. It's real. It's going to take some time, and we need you to kind of be with us and stick with us while that develops, but it's going to happen. And that was tough, right? Getting investors to believe in this vision that you're painting that might not come about. But today, I do feel like that's very different. Like in the fundraising round that we're doing at the moment, it's much less about getting people to believe in this vision. People are much more aligned that that's going to happen. It's now much more about why you at Elliptic, and do we believe in this specific business plan? So I do think that some of those geopolitical regulatory dynamics are abstracted away a bit more.
Maybe just to put a slightly different lens, or certainly like an investor language lens on that. Let's go even 10 years ago, you would have looked at this ecosystem and maybe characterized it as just unquantifiable uncertainty. There was definitely debate on will or will it not happen. We're now into a place where you're actually in sort of quantifiable risk territory. And that's not to say that everyone will come and play here, because people play on the risk spectrum at different times for different reasons. But you're definitely equipped now, or large customers, institutions, enterprises are definitely equipped now with the tools and the data to make really quantified decisions. Like, do I want to play here now or not? And they may choose not to, but it's a risk-based decision rather than uncertainty than I think we had 5 years ago.
I was about to ask you, Simone, if you could just double click on Europe, just because I think we're due, the audience on the EUVC podcast are due an update. What's happening in crypto in Europe? And is now a good time to double down? What are you seeing people do in general?
Yeah, so MiCA was a really important turning point for Europe, kind of widespread regulation that put Europe in a really strong position to say, yeah, we've got regulation that provides clarity, that allows businesses of all kinds to build here. But probably what you can say is that some other jurisdictions are moving even faster now. So, MiCA's fantastic foundation, but what about what comes next when it comes to stablecoin specific regulation or tokenization? How do we make sure that there's good harmonization that's both robust from a regulatory perspective, but also competitive amongst the European states? So we're starting to see some of that really come out now. Obviously, every jurisdiction can go through its own rulemaking, and you do start to see those differences. Do you see some of the kind of more tech-focused startups registering in certain jurisdictions, and some of the more traditional financial institutions in other jurisdictions? What does that mean? I guess the lesson from that is that being early does not guarantee leadership. And it's really important that Europe thinks about that and thinks about how do we remain competitive. That needs an explicit commitment to responsible growth and innovation. The other thing is, again, because of that rulemaking in different jurisdictions within the EU, how do you make sure that the regulations are predictable in practice? Because there's one thing writing them down on paper, and then there's the other thing is enacting them, enforcing them with businesses. Businesses need to feel like they can predict how they're going to get treated. Otherwise, that kind of is counter to encouraging businesses to make growth bets. So I think there's definitely a single market edge, but it comes with risks, either disparity in treatment or slowness to kind of stay agile.
I double click on that last point in particular, because that's where I see the biggest frustration from, insurgent companies, where there is a disconnect between headline policy and on the ground implementation. These frameworks are transformational if you read the headlines, but actually what companies on the ground need to understand and need to know is, what is the timeline? What are the practical steps that we can make? How do we engage with the regulators in this jurisdiction on practical applications of these topics? And invariably, there is a disconnect between those two things. And in many cases, it's not really the regulator's fault, actually, but because it's the on-the-ground applications where the real innovation happens. It is really true, like the devil is in the detail here. And much of that invariably hasn't been figured out yet. So it's not a criticism, but it's very much, I can see that dynamic playing out across the majority of companies I'm on the board of, where they're operating at the fringe of the sort of regulatory frontier.
Simone, this whole segment around how the geopolitical markets are moving, or how the markets are moving in reaction to the geopolitical climate, is of course a perfect tie-in to then asking you, because you've raised 79 million to date, you're about to do your Series D. I'd love to understand what principles are guiding you when you're deciding where to deploy your capital.
Yes, it's a really interesting one, and ultimately that's the job of the CEO, right? Like thinking about resource allocation is the number one thing. I mean, if we just go back to kind of pre-fundraising, we certainly did have some debates about whether we want to raise at all, right? And really thinking about what's the right thing for the business. We were pretty much on a sustainable footing. The company could, it was close to cash flow break even. There's that debate about continuing to be, fully in control of your own destiny versus being funded to accelerate growth. And it's a real trade-off between the two. Ultimately, we felt very strongly that the market opportunity is just taking off with such momentum, both because of this intersection of regulatory clarity, but then also these really practical use cases that go beyond crypto into kind of stable coins and tokenization, that just means the unlock of the opportunity that we have believed in for over 10 years is right here. And we want to be in a position where we can capitalize on that. Also, acknowledging the fact that the product set that Elliptic has built, the moment for that product set is right now. We basically said 10 years ago, money movement is going to migrate on-chain. Financial institutions, technology companies, payments, it's all going to move from off-chain to on-chain. And we want to be the ones that are providing the data infrastructure to enable businesses to confidently understand who's behind those money movements. If you take the fact that, we've built that enterprise product set and the market is there, it was like, hang on, like we have to make sure that we're funded to be able to go after this opportunity, is ultimately how we thought about it. Yes, some of it from a resource allocation perspective is about market coverage. Are we in all the right places that we want to be? Again, but going back to stablecoins, perhaps, really we're seeing the payments industry and a lot of payments rails migrating towards stablecoin adoption. And that is bringing lots of jurisdictions into scope that otherwise, when it was really more about kind of crypto trading, were less in scope. So for us, that definitely means that we're not in some places today that, like geographically, that we would like to be in, where we see opportunity. And then the second aspect is, of course, on the product roadmap. The world is changing faster than I think any of us have ever experienced. And when you combine something like stablecoins and payments with agentic commerce, A, the opportunity for us is massive, but B, our product roadmap has got to innovate and adapt at lightning speed. I mean, from a very high level, those are the kind of two big categories where we're going to be putting resources.
Where do you see and this is maybe a bit weird question, but where do you see the biggest growth coming from? Is it this fact that we have the banks and the payment system coming on, or is it the agentic trading and the need for agentic trading to work that kind of needs to get rid of all the transaction costs?
Look, I think it's for sure an and between those two things. It can't be an or. There will definitely be some sequencing. So I think we are, from a kind of go-to-market near-term perspective, really focused on the diversification of the types of financial institutions in the market. And that's, that has been playing out for a while and continues to develop. So I think that's really where the near-term opportunity is. And then I think as we look out a little bit further, kind of more into Horizon 2, that's really where the, agentic commerce, agentic payments opportunity comes into view.
I'd love to ask the two of you a question about your dynamic as investor and founder, but also friend and trusted advisor. Because I imagine, Jay, that Simone, when you backed her back in the days, she's gone on to do incredible things that were exactly what you hoped for, but now she's in a position where She has access to rooms that are very important for you to understand how they're thinking. And on the other hand, I also imagine that for you, Simone, someone like Jay, who's investing in the earlier stages with the majority of his capital, is also quite important and interesting to hear from. What are you seeing when it comes to the agentic commerce, as an example? Because I imagine that you see a lot in that, Jay, that for you, Simone, on a revenue perspective or client perspective, has yet to really hit you.
There's a couple of roles I think here that is important that I think some people don't or get to the type of relationship very late. And I think that the important thing to say about this is it's very important to understand what your role is as a VC, an investor, as a board member. And I mean, to be fair, it can be many things, but actually creating a social contract at the beginning of that relationship is really important. And that social contract speaks to how you want each other to show up in this dynamic. What is it you want from them, and what is it that they want from you? You know, investors, board members, they come in different sort of sizes and shapes with different experiences and can bring a lot of value. But the day job, the core role predominantly is to help founders understand the impact of their decisions on the capital markets. That is our day job, to help them understand that. And if you can do that, and that's how you show up 9 out of 10 days, I think that's a good baseline. What it shouldn't be, and I think where there's a disconnect, is where, you know, we show up as investor board members to try and, you know, in the worst case, tell. It should never be a tell, but in many cases, you know, show founders what customer markets or product markets they should be operating in. So I think that's probably something just to defend against. I think more than that, you're trying to be the sort of emotional counterbalance all the time. You know, Elliptic's not dissimilar to many others, and arguably at the end of the spectrum, which is, you know, the digital asset industry is extremely volatile. So it is truly an emotional roller coaster, and you're trying to be the counterbalance to that all the time. And I think if you can do those things, you set yourself up for a very long-term relationship with the founder. And the reality is, as Simone said, you've been doing this 10 years. You know, if it goes well, and, you know, we all hope it does go well, if it goes well, it is a 10-year journey here, right? So this is not something you're embarking on for a couple of years. And actually, you know, it's incumbent on everyone to really think about, like, how do you set that up? That's not something that you just fall into or falls into place. You got to kind of work at that, like any relationship in many cases.
Simone, let me hear you. Have now known Jay for quite a while, since 2019, and I'd love to understand. Well, you've probably known him from before then, actually. I'd love to understand how your relationship has grown, when you've leaned on him, how you're leaning on him now, even as an early stage investor that's still with you at the near Series D.
Mm-hmm. Yeah, sure. So Jay said something about, you know, the emotional side of it, or the relationship side of it. I think that just shouldn't be underestimated by founders and management teams, you know, both in terms of what you should expect from your investor, but also what you can ask for in terms of support, right? Like, obviously you begin the relationship mostly from a financial perspective, but it is so much more than that, or it has the power to be so much more than that. You know, Jay mentioned, and I agree with him, that, you know, the roller coaster of crypto, like it is on the extreme. All founders and all businesses go through extreme uncertainty. We've definitely been through that on multiple cycles in crypto, some which have been, you know, really tough in recent years, right? You know, Albion invested in 2019. You know, very shortly after that, we went into COVID. Then we went into a really aggressive bull market. Everyone was, you know, grow, spend. And then it was like everything fell down off a cliff. FTX, everything. It was really rough. And I think the emotional support that you can get from the people in your boardroom has an outsized impact on how you make decisions, how you show up inside your company, and the level of confidence you've got that ultimately it is going to be okay. Like, it's going to be really painful for a while, but it is actually going to be okay. And we've got your back. Like, that's a really powerful thing for a CEO to feel when everything else feels like literally the world is just burning around them. You know, Jay and the team have always been incredibly thoughtful about how they show up in that moment. The other thing is, it's not just all about the business, right? Like myself, the founders of Elliptic, like we've all had like small kids during this process, or like other big life changes. Like, you know, we're all full humans with full lives, and I think having that kind of acknowledgement and connection with each other just means that when you need to have that really hard conversation, you're much more likely to have that when you know the person on the other side of the table sees you and the full context of that you're building the business in.
Jay, given you just got unsolicited praise for your ability to show up, I want to ask you a question, because we all know the founder stories of everything being great with their investors when things are going the right way. I spoke to a climate investor the other day, a climate founder the other day, who described exactly that scenario, that everything was up and to the right, and then climate kind of fell off a cliff after Trump came back in January last year. And since then, the boardroom turned quite sour. And he had not seen that coming. He had not seen it in the investors beforehand. And he was honestly very much let down. And now they're figuring out a way out of that company for the investors, and the founders will continue. I'd love to understand from you kind of how do you keep grounded as an investor? Because you do have a fiduciary duty. You do want to, you do bet your own career on these founders and their startups. What makes you able to keep your calm in these difficult times?
I think there's just a sort of a level setting sort of understanding of what the product is that we as VCs ultimately sell to founders, right? And that is a product that, I mean, depending on what stage you invest, but let's say 60 to 70% of companies don't make it, right? This is the baseline. This is not the exception. So actually, on average, you're dealing with portfolio companies that are not going to make it or not doing well much more than you are dealing with the ones that are going to make it. So it's not.
But then let's make it more difficult then, because my question to you is then, how do you as the early stage investor work with the growth investors that do not have that perspective? And how do you work with the CEO in the situation where there are investors on the board and cap table that do not come from this, I know I'm going to lose a large chunk of my capital anyway.
Yeah. So
and thus they are turning on the thumb screws when things are getting harder. They tend to, at least.
Even before you get there. Okay, that's another question, and that's another exam question. Even before you get there, you're gonna be dealing with companies that don't make it. The reality is, you can only really do what is fair and is right to support the company and the founders. And look, 9 times out of 10, this ultimately goes back to why we all spend so much time trying to evaluate and understand the founders of the business, not just the market opportunity and the product leadership, but the founders of the business and how everyone will behave, to the points I was making earlier, in these times of stress, and that because there will always be times of stress. And so you're always just trying to be there to problem solve with the founders and unlock the next opportunity. In most cases, as I said, this is going to be how to help the team move on if the company's going to go into administration, how to maybe even offboard customers if you're in that part of the company life cycle. Obviously the minimum you can do as an investor is to not frustrate that process. But ultimately, if you've, invested behind a really good founder, they want the best for the business at that point. And they understand that the end to the business may be, in fact, to hand it over to another institution. And you should try and facilitate that. The second question that you ask is an infinitely more challenging one. And that is unifying the voices of a large board at the point in time. And, Simone said, when you get to Series D, you've got lots of different motivations. You've got lots of different positions in the capital spectrum of the company. Let's say each of those funds has a different return threshold. And that's really difficult at that point. And so the part of the role of really all of the investors at that point, are certainly the directors, but increasingly, and importantly, the chair of the business, and Elliptic's very fortunate to have the chair, is to try and unify the voice of those investors. Typically, there is some central North Star here because you've anchored on a North Star, and typically as part of the fundraising process. And so there is some alignment on what everyone is trying to achieve. I think the thing that I've noticed working across a sort of spectrum of companies at different stages is early communication on the underlying incentives of each of the stakeholders. So our return threshold is very different from a Series D return threshold. And ensuring that there is an alignment and an early understanding on how those two things are compatible is really important. And the breakdown in the companies, in the stakeholder group you're describing, is when there isn't that, when there is a significant change in the North Star that not everyone is aligned about, or you have some delayed communication for some reason. I think you turn over directors. Let's say there's a change of director, and this a new director has a different point of view, and then that's just a really difficult point of time and a really difficult stress situation. And the other point is it's not a one and done thing here. This is an ongoing effort to work at these things. They happen all the time, whether it's a capital issue, whether it's a talent issue. That is just part and parcel of the asset management part of our roles.
Simone, how do you think about it? How do you think about, as the founder and CEO, of bringing together the group of investors for you?
Yeah, look, it's really hard when the business or the wider market's going through periods of stress. I think that I found early and frequent communication to be my friend. Ultimately, even if there's things you don't want to be saying, it is exactly, it's much better to be communicating those things early and often. It breeds more confidence than silence, which makes everybody nervous. So I have definitely learned that the hard way, but I think as soon as I started practicing that, I felt a big difference, a big shift in how the board kind of showed up and kind of engaged with the information, even though, as I said, sometimes the natural inclination is just, I'm just going to hold this close until I've solved the problem. But then you're not using the board to help you solve the problem. So I think that's definitely something that I've shifted a lot over time. But, you do, as Jay said, you do have to go in knowing where the different kind of pockets of interest are and what different board members are bringing into that room from the rooms they've just come from. What's the discussion just been at their IC or their partner meeting, and people, they've been reviewing the portfolio. And, I think that we as company builders can often forget that actually, like, VCs are themselves accountable. Everyone has a boss, right? Like, they're accountable out, to the LPs, and, they're thinking, they're often fundraising as well as you're fundraising. So I think I've, again, just also been guilty of being so focused on my own business, not thinking about what is it that they're experiencing, the questions they're answering, the data they're looking at. And that also, that having more empathy around that helps. You have a more kind of direct conversation about, the way things are going.
We hadn't planned this conversation, but I thought it was worth having because it's a constant struggle, of course, and I'm surprised every time I meet founders and VCs where it's gone wrong. It's just such a sad story to see. I want to go back a bit to the market and want to ask you, Simone, where you see the most credible near-term opportunities for startups that sit between the crypto-native system and their more traditional financial services.
Yeah, so look, we've talked a bit about stablecoins already, but I do think it's worth double-clicking on, and I think Jay will correct me, but certainly I think some of the opportunities they're seeing are in this space as well, particularly where payments companies are really looking at how do we reinvent the infrastructure on which we're built. And I think the beauty of stablecoins is that there's so much activity happening in the space that actually most people can't even see, right? Because it's sitting in the background as infrastructure now, helping move funds around the world faster, more cheaply, 24/7, 365. Really thinking about what does it mean from a future world of agentic as well. And certainly when I think about kind of what we call crypto native businesses, that's really where as well as in the exchanges, the large exchanges, that's where the growth is. I think that people experimenting with how do we make this even easier? How do we abstract away a lot of the complexity so that a payments company or a financial institution can just plug us in order to then access this whole world of stable coins so that it truly does sit in the background. The customer experience, whether it's an institution or a consumer, doesn't really have to think about it at all. I think it's in that abstraction layer where there's a lot of opportunity right now, and that's what's bridging on-chain and off-chain.
Yeah, I mean, I can only build on that really. We have to remind ourselves that we sit in this tiny little bubble in a really niche part of society, technology, capital, and 99% of the world doesn't live in this bubble. And so even when we talk about, when we talk about the future, obviously we've got to bear in mind that the 99% of people are still to get to where we are today. And so, I think we're the vision. I agree with Simone. I'm definitely on this bandwagon, which is like the interface with stablecoins is to an extent now inevitable, and it'll get to a point hopefully soon where we don't really understand when we send money somewhere how that money arrives, on what rail, what is the underlying currency and transaction mechanism. We are a long way away from that, but that is definitely the vision. But actually there's some credibility now, I think, in that vision, because as we look at the sort of maturity of markets, it's never one driver. It's always the confluence of a number of drivers. And I think we're at the inflection point now where we've got regulatory drivers, we've got technology drivers, we've got capital drivers. So the underlying technology infrastructure, you've got API connectivity now across really every element of financial services. You've got a tool in stable coins that is showing a level of robustness and transaction level to provide the capacity to support that. You've got enterprise adoption and institutional infrastructure to be able to manage all of those things. And so I think there's a credibility now in this thesis that we are investing behind. The sort of second order effects of that are really important. And as we start to look at sort of specific investment opportunities, we're obviously looking at Elliptic was a great case study here, but there is a second wave of, let's say, call it risk tooling that hasn't needed to exist today, but certainly will need to exist to enable all of these use cases in the future. And so what are the early stage opportunities there? We invested in a business earlier last year called Agio Ratings, trying to define a risk model for digital assets. Again, conceptually, something that you feel needs to exist, hasn't needed to until now. And so that's a great example of the types of tools that we will need and that we're getting excited about.
Before we close, I do want to touch on this agentic trading because it's something that captures the imagination of many. I'd love to ask both of you just to tell me where you see the market being right now, where you're seeing the first use cases happening, when we should expect it to be a little more, pervasive, versus how long are we going to have it as something that we can imagine will be important?
The short answer is it's happening today, and in fact, it's by far the majority of stablecoin transaction volume today. So I think it's something in the order 70, maybe 80% of stablecoin trading volume is bot related, let's say, and actually only 20% is real world use case. So actually the majority of that activity is call it agentic today.
Jay, sorry for interrupting. And that is because that trading is happening between bigger institutions that are much further along.
Typically, exactly. Yeah. So these are
e-commerce
these are wholesale institutions, exactly. So we're not yet there on consumer-led e-commerce transactions, for example. Yeah. But that is the next wave. And what's interesting there is actually that is counter to how crypto really developed, actually. So crypto developed as a consumer use case. initially.
Yeah, it started as a very democratic movement
and backed into an institutional use case. In fact, anything, we're establishing the infrastructure the other way around here. And this is an example of where we'll see a combination of technologies here. It is not just the fact that we now have stable coins that will allow this, and you can have micropayments and you can have agent to agent payments. There's a lot more technology drivers to this trend as well. And we haven't developed the governance frameworks around that yet, but it's coming.
Yeah, Jay, you mentioned governance frameworks there. You know, we sell to lots of different types of businesses, and harmonizing between them and their various needs, and particularly their different approaches, is a real sort of skill for us. It's something that we work really hard on. So on the one hand, you've got those very tech forward businesses that are already deep into kind of building for this future. Then you've got a kind of the more incumbent banks who are really interested in this future, but are often more conservative and kind of bound by policy, procedure, testing, making sure nothing they do is going to kind of put the bank at risk in any way. And then a kind of third set of constituents are the regulators, who again are naturally conservative, but the best ones really understand how to balance responsible innovation. Like if we think at Elliptic just about deploying our own AI-enabled crime detection, you've got three very different attitudes to our roadmap. Some who are like, go faster, go faster, go faster, we want it now. And then others who are like, oh, what does this mean when you're reducing what a human compliance analyst is going to do, and that you're going to use an agent to auto-resolve a bunch of these alerts? How do you know that it's going to be making the right decision? And how can you back test it? And all of those things. So you've got this full spectrum of risk appetite when it comes to kind of developing these solutions. You can't just kind of solve for the lowest common denominator, or you'll be behind, and you can't run out ahead with the ones that are really kind of pro technology, because you'll leave the others straggling behind. And actually you need all three. You need to, part of our job is how do we bring all three as as close alignment together as we can. It's really tricky.
The other lens here, just as I dimensionalize this, so the most progressive institutions here are probably at the stage of unifying the evaluation of risk as it relates to transactions in both fiat and digital assets. There is a unified plane in which they do that. But that is on the most mature end. 90% of organizations are not yet there. You know, if you have digital assets as part of your treasury management policy strategy, most organizations are running these treasury strategies independently. And like that just gives a bit of a framework to evaluate the market maturity and how far advanced we are towards this sort of nirvana that we were describing earlier versus where we are today.
It's incredibly interesting and it's incredibly exciting to see how that the crypto market and solutions are now finding its way into the spotlight, but without all the fanfare, but just through real fundamentals. I think it's so exciting, and I think it is a much healthier route to get there than what we saw 5 years ago. Simone, Jay, thank you so much for joining me today. Simone, congratulations on your massive success. I'm sure your Series D is going to be incredible and massively oversubscribed. Thank you, both of you.
Thanks. See you.